Hello and welcome to the third of our CIMA F3 Financial Strategy lecture recaps. This one is on business valuations. Okay, why do we want to value a business? Well, usually because we want to buy it. And if we buy a business, we get what are called synergies, which are savings through combinations. Operating synergies may be economies of scale, complementary goods, or reducing the inefficiencies within either of the businesses. Financial efficiencies, well, these will be got through diversification, reducing the risk if you're buying an uncorrelated business, or what's called the bootstrap price to earnings ratio, and we'll look at that in a bit more detail later. Other synergies might be the use of some talent that you have available in the firm, use of surplus cash, or simply increasing your market power. Okay, so those are all the synergies you're trying to get by buying a business. How are you going to then value the business? Well, the first method is the net assets valuation method. Now we use this method when we are maybe asset stripping a firm, or as the minimum price during a takeover, or perhaps if you're valuing a property investment company whose only assets are the property investments. Problem with it though is the valuation of intangibles. If you've intangibles on your balance sheet, how are you going to deal with these? And we did an example of this in class. Second method we looked at was the dividend valuation method. Now this is based on the present value of future dividends received. So to calculate the share price, it's the present value of the future dividends. If you're paying a constant dividend, well then the share price is calculated as the constant dividend over the shareholder rate of return, or your cost of capital. If you're paying a growing dividend, well then your share price is your constant dividend plus your growth over the shareholder rate of return less growth. Okay, the weaknesses of this method, well, it's estimating future growth, and anything based on estimate is always going to be a problem. You're assuming constant growth, again it's an estimate, can cause problems. And the valuation is very sensitive to changes in any of the variables. Okay, so those are the problems with the dividend valuation method. The price to earnings ratio method, well, we looked at some calculations, and you need to know how to calculate the share price, and that's your earnings per share times your price to earnings ratio. So therefore, to value the company, you're going to get your total earnings and times it by your price to earnings ratio. Points to note if you're using this sort of method: you may use the price to earnings ratio of a similar company, for example if your company isn't listed. You can also adjust this price to earnings down by 10% in two situations: if it's a risky company that you're looking at, or if it's unlisted. And we looked at an example of both of those in class. Something else on the price to earnings ratio model is just about the earnings yield. What is it? Well, it's your earnings per share over your share price. You can use it to calculate your share price, therefore, as your earnings per share over your earnings yield. And to value the company will be your earnings over your earnings yield. And again, we did an example of that in class. Another method of valuing the company is the present value of future cash flows, i.e. calculating all the future cash flows and discounting them to the present day value. So basically it's a company-wide NPV calculation. Weaknesses for this are, well, you have to estimate your future cash flows, you have to know your discount rates, what time period are you going to do it for, and you have to assume a constant tax rate, something that's probably not realistic in the real world. So those are three methods of calculating the value of the company. How are we going to finance the takeover of the company? Well, we can make a cash offer. Advantages of this are that it is relatively cost effective and timely. It's a certain price. It's going to be good for the target shareholders because they get their cash and that's the deal done. Also, if you're offering cash, as with anything, you can offer a little bit less. However, potential disadvantages with the cash offer: you may have to borrow or raise the cash, which is always a problem. The shareholders who receive the cash may have tax issues, and you don't get any new shareholders. You're stuck with the same old shareholders. Can be a good or a bad thing. Second method of financing the takeover is loan stock. The advantages of it is that if interest rates are low, which they are at the minute, it's going to be much cheaper. The interest that you pay is tax deductible, and it's going to less dilute your earnings per share than a share for share offer, which we'll look at in a second. Disadvantages, of course, are that it increases your gearing and therefore increases your financial risk. Okay, the last method of financing, the share for share exchange. This is simply offering some of your shares in exchange for shares in the other company. The advantages are the target company shareholders remain, so you've got a wider shareholder base, and it can also finance very large acquisitions. Disadvantages are, though, that if your share price falls, of course the bid may fail. Now, to calculate this, we went through a certain procedure. We calculate the value of the predator company, the one buying. We calculate the value of the target company. We add in the value of any synergies, and we divide by the number of new shares. And we did a little example of that in class. Okay, back to this bootstrapping price to earnings ratio. It's when the price to earnings ratio of the large company applies to the combination, and may bring the price to earnings ratio of the smaller company up to match that of the larger one. We did an example of that in class. So a final few points on takeovers then. We have to be aware of the city code when it comes to takeovers. All shareholders should be informed as soon as possible. All information must be disclosed. If a company buys 30% of the share capital, it must make a full offer for the business. That offer must be open for at least 21 days, and it can't withdraw the offer unless the exchange consents to it. Now, a business who is subject to a takeover bid has several defences to it. Before the bid, they can appeal to the shareholders. They can apply the white knight strategy. They could counterbid for the other firm, or they could go to the Competition Commission. Pre-bid, poison pill strategy, make themselves unattractive to the business, sell off their crown jewels, award golden parachutes to the board members, or fix the articles so that they require a super majority, maybe 70%, to pass any resolutions. A last little word then on management buyouts. There's some considerations when the management are going to buy out the business. Number one, do the current owners wish to sell? Number two, is there the potential in the business to bring it forward? Can they run the business when they lose the support of the head office? What price are they going to offer? And is the ability there within the management to run the business well? These all have to be considered when a management buyout is on the table. So financing that management buyout, how do they do it? Well, they could take out loans, they could use their personal wealth, or they could use something called mezzanine finance. This sort of finance falls between debt and equity. It's neither one nor the other. It has floating security over the business assets. Downside of it, though, that the interest rate is going to be above straight debt, so they will have to pay for it. Okay, so that's a quick run through business valuations.